All right. Hey there, Michael Hopkins, Seeking Alpha with, again, Jennifer Warren, Concept Elemental. How are you?
I'm good. Good today, Michael. How about you?
Doing good, doing good. So we posted this article on Seeking Alpha, May 25th, Innovation Economy, the big shifts in use cases. This was part of you attending the conference, Technology Enabled Disruption. It was in Richmond, Virginia, with the Fed in Richmond, along with the Atlanta and Dallas Feds. And we got that article out. So just real quick, how was that conference, and what can you say about it? Maybe some background on what that whole thing was all about.
Sure. So this tech-enabled disruption conference, they've done it for a number of years, and they rotated around the different districts. And one year it was actually in Dallas, I think 2019. And this year it was in Virginia, the Richmond Fed with Atlanta and Dallas Feds. And so you had all three of those presidents there as well. And so I got to hear from them. And one thing this year that was different, and part of why I went there was that they had, I mean, probably 40% of the conference was about the energy transition. Because, with tech-enabled disruption and what's going on with the energy transition, it overlays well with all the new developments in technology. So you had this, macroeconomy factors, technology disruption, energy transition, and it was split between business leader panels. So you got to hear from, executives, CEOs, whatever level, high level people in various industries, and the academic discussion, those academics doing the research, cutting edge research on these topics. So it was really a lot. And it's been a week, 10 days, and I am still, my brain is still kind of trying to process it all,
Yeah. So just real quick, some key takeaways. I mean, it's not just your background with mostly energy, and I don't think it's a fair. I mean, I think you're much broader than that, but there were some key takeaways, not just on energy, but there was tech on the economy. Maybe you just outline some of the things that you saw at that
Yeah.
conference.
Yeah. I mean, I would say what I've kind of synthesized myself is just from all the learnings. And I've done 4 videos just trying to capture how I'm processing this even in sort of real time. And, obviously, as we've come out of the pandemic, there's a reset, right? And we're still trying to figure out where we are. And then the other aspect of the reset is that interest rates have risen in response to inflation, a flood of which happened post-pandemic. And then all the supply chain disruptions that have happened through the pandemic, those working through. So, and then you have a war in Ukraine, a Russia, induced war in Ukraine. So you have all these things happening, interest rates rising, those lag effects starting to filter through. And in a primary area that we are seeing it in is, commercial real estate. And I think the market and people are still wondering, okay, what dominoes are going to drop next, and how's this going to impact the economy? And the other thing too, big picture, was just there was some discussion about remote works effect, and obviously that plays into the commercial real estate, the office buildings being, the vacancies reducing and people wanting to work remotely. But they were also saying that, some of the leaders on a panel the last day from Capital One and a healthcare executive and I think a real estate executive, they were just saying that, now 3 days a week is it's been kind of a norm on those that can work remotely, but people are, firms are trying to, get people back in the office more, but there's also pushback. And then the second thing that we're seeing, and that this is just something I've been really noticing this week more, is the layoffs. there was a chart today in Bloomberg just discussing that there's been like just this year, like half a 500,000 layoffs. And a lot of these are white collar layoffs. And then even this month, there was like 5,000 layoffs attributed to AI. So that's interesting, that's kind of starting to filter through the economy. So those were some of the takeaways, and the other takeaway, and I guess we could look at some of these charts. The reindustrialization theme is happening, and that's this, I sort of talked about reset, rebuild, and regenerate. Reset, just what I was talking about. Rebuild, this sort of reindustrialization, the changes in energy mix, how we produce it, how we consume it, all that's changing with technology. So those are some of the big themes and takeaways. Did we want to look at the slides, or did you?
Yeah.
Okay,
Let's
so
go ahead and jump into the slides there.
okay, yeah, because these visuals, let me just screen share. These visuals are helpful. If I can get to it. Here we are. Okay, so this is the Fed districts I was referring to, and I talked about this in a video a day or two ago, and it is this reset, rebuild, regenerate. It was sort of the background to this, and I kind of went into a little more detail, but here you can see the districts. So here's District 5, Virginia, North Carolina, West Virginia, Maryland, DC, 6, Georgia, Alabama, Tennessee, Florida, and then the 11th district, which is Texas. And so now on the panel, some of the energy transition people were from the 5th and 6th district mostly. So that was an interesting perspective to hear from them versus the 11th district where I'm from, where there's an enormous energy specialty, with that Fed, their research department. And then this is just kind of showing, this is something I just pulled as a result of, being at the conference, was just, I wanted to see actually in real terms, what generation is coming online between like this spring and next spring. And so it's actually a lot of solar. Solar is this, obviously this yellow dot, and natural gas is this sort of brown dot, and this is nuclear here that's coming online, and that is South Carolina. And I kind of looked at some of the energy mixes of the different regions. I just wanted to see, okay, is anybody more, you always think, oh, the 5th district, DC, Maryland, all this, they're more green than Texas per se. That is not true. I actually looked at their energy mixes, and Texas kind of actually leads the way. We're like 25%. This was in, I think, 2021, 25% of generation comes from renewables, another 50% natural gas. Virginia was actually had the largest natural gas share, like 60% of their power gen, and this is from 2021. And then 30% nuclear. Georgia has like 30% nuclear, 50% natural gas. So what it was saying to me is, there's a lot more natural gas than I even imagined. I always knew it, but it just kind of, some of these hard numbers were kind of interesting. And this is where it's happening. And if you look at this, a lot of this is happening, this solar, and then the wind is the green, is happening in the Sun Belt, where a lot of the, also where a lot of the reindustrialization theme is happening, because there's all these plants being built, semiconductor plants and battery EV plants and all this. I mean, it's battery EVs are distributed a little bit more evenly across the United States than the semiconductor thing. There's a couple in Texas actually. And then this is just, I talked about this in that other video, and geez, there's a phone ringing. Sorry about that. Can you hear that?
I can't. No,
oh,
but
good. Okay, noise canceling. Anyway, this is just kind of showing that, right here, 2005-6, that's when the shale boom took off. And we see this greater proportion of natural gas. And one of the professors did talk about LNG and we've talked about it before, but it's just LNG is, it seems like it's here to stay for a long time, and the United States is going to have to get on the ball with some of the permitting for these LNG facilities, because there's a lot of demand centers in Asia and Europe that really want US LNG, and that's especially because of what's happened with Russia. And our supply, we're cleaning up our production more and more, both with oil and gas. Now, this is here are your maps, Michael.
Yeah, I like the maps.
Hence the Fed map that was with you in mind. So here's some of the shale plays, and again, just kind of pointing to, for all the discussion of technology and innovation, it requires energy and energy resources. We are well endowed with, oil and gas, as reflected in these shale plays. Right here's the Permian. Barnett Shale's kind of where the natural gas revolution started, and then it quickly went to the Marcellus up in the Northeast. Pipeline constraints there. I suspect over time that may change. Hard to say. And because of the Marcellus having some, sort of some headwinds getting the gas out to the Gulf Coast, the Haynesville here in Louisiana has come online more. It's producing more. And then the Bakken up here, Niobrara, Colorado. And that actually kind of interesting. Let me just see what the next one is. I was looking at the regions too, and this wasn't at the Fed. This is just me kind of giving a little color. We see this. This is new well production, and now this is production by region. Up in the Permian, the Bakken, and this is gas over here on the right side. Permian, there's a lot. Actually, it's the top change in gas production, and that's because of associated gas that happens as a result of oil production. Appalachia, just kind of cruising along. Haynesville, in fact, more productive than in Appalachia, which is also interesting. And this is just kind of getting at something that was also talked about in the conference. It's just the supply chains, and we've discussed this in that oil, gas, metals, and minerals, that China dominates a lot of the battery supply chain and processing for metals and mining and mineral. I mean, they get the raw, materials from around the world, but then they dominate a lot of the processing. And that's something that, policymakers are trying to change. We're trying to bring more of that mining, to other parts of our country, as well as like North America. And that's just going to take time. As we know, those mines take a really long time to develop. And so that just means the energy transition on the resource front isn't happening as fast as one would think. It's bumping up against the, the resources of the earth. And that's the tension between innovation and energy, is that energy is based on natural resources largely. And so, there's a finiteness to that. And so we can think all sorts of things, but there's always going to be constraints in the physical world. But, we can learn how to do things better in the physical world as we are, which shale reflects, even just advances in technology and being more productive and more efficient. This is, again, just showing, that China sort of dominates the battery supply chain. And then this is actually something from the Fed conference. One of the professors, I think his name was Joshua Lin, and he's actually from the University of Maryland, and he was very much an EV, his research is on EVs and that space. And basically what this was saying, he was saying that, EV penetration is like around 10% right now. And what that number relates to is that for new cars sold, that roughly 10% right now are EVs of new sales. So not necessarily that 10% of the fleet of the United States is EVs. I don't think that's what he was getting at. And so this is just, showing, how high the penetration goes per car maker, as we see Volkswagen, BMW, Ford in the middle. This is 10%, meaning of new car sales in the second year, what those percents look like. And then he said also, so if we have this 10% penetration of new sales, and then we can go to 20, that's doable. But after 20%, it gets difficult. And that has to do with the energy mix, the grids, transmission lines, the ability of the grid to handle, plugging everything in. And then also just somebody that was a semiconductor expert discussed too, just that this electrification is expensive. It's going to be more expensive with inflation, with demand for all the critical minerals required of the energy transition. So that is a headwind factor. So deglobalization, decarbonization, both inflationary, adds cost. Okay, so this is I will stop. Oh, there was one. I think that was it. Okay, wait. I just wanted to show you this too. This gets at tight, shale. Shale has really been the reason that the peak of oil production has continued because of shale coming online. This is the United States contribution to the oil market, basically. And were it not for our production, we would be at the mercy of OPEC and Russia for price. Prices would be really high. And so it's really ironic, that the industry gets sort of, the bad rap, but in fact, they've kind of saved the day on prices in a general way. And this is just showing, this is projecting. And now this may be conservative, I don't know. This is a pretty good analyst, and he's on Seeking Alpha, actually. And this is right where we are about now in 2023, 8.3 million barrels a day. And he's estimating that shale production peaks. I think this is like around 2028, 20 or so, and kind of plateaus, and then it starts going down. Now, this is all dependent also on the energy transition. So this is factoring in, if everything kind of goes well, now, so that's really a wild card, right? So I'll stop sharing there.
Oh, go ahead. I didn't want to interrupt.
No, that was it. I mean,
yeah. So yeah, but so looking at the maps, the graphics, the energy mix we talked about here, and all that data that you presented, what is the transition or key dynamics in your mind about energy now and the transition? What stands out from all of this data?
Yeah, I would say even with the IRA legislation, which is incentivizing a lot of new developments in decarbonization, such as CCS, carbon capture and sequestration, finding other ways to not combust oil and gas in the same ways as before. The IRA incentivizes that. As a matter of fact, on a transcript today with ExxonMobil, the CEO discussed some of this, and he just kind of like confirmed that this decarbonization drive, the new technology associated with it, it's going to help, but it's going to take time. It's going to take a lot of money. For example, they spend $1 billion on R&D a year. And they have been rewarded for sticking to their core competencies, but moving the needle with technology to become more efficient and to produce in a decarbonized fashion, even more so than other majors. And I'll show some charts that are reflective of that. And the other takeaway on the energy transition is just that what I really noticed from the Fed was that this struck me was that there's really more regional variation going on. We think about the transition in a very abstract, big picture way. Okay, we're going from fossil fuels to an electric world and greening up everything, and then there's all these spaces in between. But it's also, but it's also happening in geographies, and that pertains to a number of things. Where resources are located, where the natural resources and the energy sources are located, but also human capital, innovation. On the East Coast, what I noticed was, obviously there's a lot of brilliant minds, at these universities working on the issues of, electrification, Maryland. I mean, I know that they're very into that. I mean, and actually their air seemed pretty clean. They have a lot of EVs there. So different regions, I think, are specializing differently, like in relation to Texas. Okay, we produce a lot of the United States oil and gas. But a lot of the firms here, whether it's the independents like Pioneer, Fang, Diamondback, or Chevron, because they do a lot of Permian production, as does Exxon. They're looking for ways to decarbonize. They're trying to electrify as they can their production in the field to, reduce those emissions. And so you get these regional variations. So, while there's this greater focus on EVs and electrification, perhaps in the 5th district, versus the 11th district, that's all going on too. But we also have this legacy of oil and gas production. And as we know, oil and gas, oil is like, we're at 101 million barrels a day. It's still projected to increase. And so, and gas, natural gas increases because we're part of a global system that demands gas. Renewables, it's just not moving. It's moving, but it's not going to achieve the penetration levels as quickly as one would think, especially in the developing world. I mean, it's just, and some of those headwinds are the very things I talked about, mining metals, minerals, all of it. You've got to be set up for all that. And we're even struggling in advanced economies, now maybe they can piggyback off, leapfrog technology some, that's possible. But so those are some of the energy takeaways. I think that with AI, I think that's going to lend itself to greater efficiencies, finding more efficiencies, sorting through reams of data and information to help us, reduce waste, reduce use, produce better. So I can see all that happening. And the adoption process is starting. There's been a lot of announcements even since the big AI day, last week, I call it the AI day. And so I think that's a factor, and it gives the opportunity for, like this regeneration of the energy transition as well. So
it's interesting you bring up that efficiency theme. And again, it's not just about the energy, it's also about, like you said, AI. So let's get back into the conference a little bit more. Is there an investment theme that struck you as a result of what you observed while you're in Richmond? And it also seems bigger picture here. I mean, we're not just talking energy, we're talking tech, we're talking the economy, we're talking lots of things.
Yeah. Well, and I think for sure, while there's all this sort of micro focus on, what's the Fed doing? Where are interest rates going? Okay, that ship sailed. That ship is where that ship is. And okay, so, maybe you raise it another half a point, maybe at the worst. What's the worst case scenario, down the line? I don't have that answer, but I think you can kind of imagine where we are, right? That, maybe we're getting to this peak. And while we haven't seen all the lag effects, we can envision what that looks like, but you still have to pick your point on the horizon, right? And I think what came to my mind, aside from it, confirmed my energy picks, basically. I still have a heavy weight in, oil and gas, and particularly those firms that are really looking at using tech, collaborating, trying to decarbonize even while they're producing oil and gas. And then outlier things, like nuclear. I mean, it's not an outlier. It's going to happen more. We're going to use nuclear energy more in the future. Just, me making a prediction. The IRA legislation incentivizes it. And there's also this need for density, energy density, which nuclear can supply. And so there's a lot of new ways that that's going to happen. And so I kind of am just focusing on the things that I really am comfortable with in the energy transition space, and where I feel like the returns are there or will be there. And then the other investment theme I would say is, semiconductors, tech, just, I know there's the FANGs and the hangman and all that. And, the triple Q, is the proxy for tech. And that has been really kind of, it went off the rails last week, and it's kind of coming a little bit down to earth this week. But I think there's just some long-term legs in all that. So did you want to look at those slides?
Yeah, go ahead and take a look at the next set. Let me find them. Get rid of that. Okay. So this was just something I looked at last, a couple days ago. And here, this 125%, this is over a year. I don't know why this is looking so big here. I can't seem to get. Anyway, this is the day that NVIDIA went up. Just that big sharp increase. And SMH is a semiconductor ETF. It's this line here, and it kind of went along with NVIDIA, but that particular ETF has a balance of other firms in that space, and so it's a different way. I think NVIDIA is like 15% of that particular ETF even, and XLE the last year down, S&P up a little bit, clean tech, that particular index not doing so well. And this is just a 5-day look. And I just wanted to show the sharpness in the rise of NVIDIA. And, those articles in that AI video were capturing all of that excitement. And then you see here that semiconductor ETF over the last 5 days also cruised along, and if you look at its constituents, you'll see why, because it has some of those sort of bellwether tech firms. And I know a boutique investment advisory firm in the Bay Area that has had this particular ETF for, a long time and has done well. So this, I just wanted to show you, this was from your site, and this was at the first of the year. Now, this is what's kind of interesting. ExxonMobil was up 10%, Shell down almost 6%, S&P down, Microsoft down 12%, Triple Q down 15%, NVIDIA down 23%. That was a year ago.
You know,
Mhm.
what a difference, a day makes, right? And I think that kind of gets it, you've got to kind of look at this in slices of time. And, if you're trying to get an outlook that isn't just short term, you need to be willing to, stick with some things, if you're not just going to trade. And then this also has, this is a year. Coterra is natural gas. I wanted to show what's happened with natural gas since last fall. There was this warm winter, too much production, all that. That kind of got hit. That's going to change. Long-term trends are good for natural gas. And then this is showing SETM is actually a minerals ETF. And that has been down for the last year, like 21%. So for all the discussion and all the focus on, the energy transition, EVs, metals, mining, all that stuff, there's been, some underlying weakness in some of these funds. Triple Q's been up because it's just got more balance to it. It's representing the NASDAQ 100, right? Exxon up 7%, lithium down 15%, and then the other thing I wanted to show you is something a little more dynamic. Okay, so this is actually online. So again, if you go to the beginning of the year, now this is interesting. I added in SLB, which is Schlumberger Oil Field Services. Baker Hughes, Schlumberger, I noticed even today, I feel like they rode some of that NVIDIA tailwind. And that's because, they use a lot of data analytics. And when you're talking about oil and gas production globally in the Permian, shale tech, there's a lot of data and AI that can, that's an assist for that. And so that's where I think it gets exciting about, the overlay of technology with energy, differently than just how we think of the energy transition in terms of classical, the fossil fuel to renewable, electrification of everything. It's a different dynamic, I think. And I like that lens of just really, separating out maybe hydrocarbons and electrons, and then how's tech interplaying with those spaces differently. And then here, the semiconductor one was down 15% at the beginning of the year. And now, as you can see, it's, things have changed even in the last 6 months. Exxon's still up 6%, XLE down 14%. Now, what's interesting about that is if you look at its constituents, there's been some softer demand and it's gotten a bit hammered from that. But Exxon has just ridden through all this, right? And I think it's because they're one of the majors that has really stayed focused on their core competencies, acknowledging how they're going to play the decarbonization, angle, but doing it within their own wheelhouse, within their own core competency. There's a lot to be said for that. So it's kind of like, there's a specialist world, there's a macro world. And then if you're a macro firm like ExxonMobil, you pair with the specialists. CVX does the same thing. They haven't performed like Exxon. And I haven't dug into that, but I suspect with Exxon, again, it's just the strength of their core value proposition. And then also where they are doing a lot of this activity, it's the Gulf Coast, it's Texas. And so there's kind of that, Texas oil and gas dynamic going on. I think that was it on the sharing of the slides.
So when we look at those slides and the stock slides, And also taking into thinking about the conference that you were just attending, what are the risks? What's the thing at the top of your mind in terms of what could be the risks?
Yeah, good question. There's several, a technology risk that
Yeah.
that we overestimate what technology is going to do. Technology risk that we underestimate what technology is going to do. We think that, it seems like the transition isn't happening as fast as we think it is. Well, there can be breakthroughs, right? I mean, what if there's like this, small scale nuclear modules just, really, really, show that they can do things that we didn't anticipate, and ocean wave technology, it's denser than wind and solar. Maybe there's just some revelation in that, and that actually ocean wave technology is kind of marching along. The other risk is, the one that's always staring us in the face, and that is geopolitical risk. And
Yeah.
staring me in the face because I'm in energy, and then thinking about supply chains. But just what happened with Ukraine, how it's changed the trade routes in oil and gas, actually, and how it's impacted the energy transition, like in Europe, for example. They've had to backtrack some on their green ambitions. Now, that could have happened anyway once you start getting those minerals and metals, in grid headwinds. But again, technology, there may be breakthroughs and new ways to do things that, that happen, and that, put us in a new phase, right? Just like the AI day, that kind of, put things in a new phase. But now, now there's a lot of announcements too. I mean, a lot of announcements, people trying to ride that, firms trying to ride that train. And, and so it'll be interesting to see how it's used, how it does add to productivity. In the last video I just did, the backgrounder, I showed a slide about there's, the productivity from AI and LLMs, large language models, and all this. You could get 10, 20, 30% productivity boosts, and that's a way to, de-inflationize, or whatever, disinflationary. It's disinflationary, just like globalization was disinflationary. Well, AI could be disinflationary as well. So I would say those are the two big risks. And then the other one that I talk about a lot, and this is always top of mind for me, and that is that we risk thinking that with innovation, our innovation minds are very creative, and, we just kind of see something and take off with it, kind of Hyman Minsky moments, the mania. And, irrational exuberance, as Bernanke would say. That we just, we get ahead of ourselves, but then the finiteness of the natural world is always there, and so there's this tension, right? And that comes back to this creative destruction idea of the economist Joseph Schumpeter, and he's actually one of my favorite economists. But I see that playing out, like these layoff announcements, oh, we're laying off people because of AI, well, and it's a bit of an excuse to lay off people, but it's also this idea of, oh, you know what, we can do this better with fewer people, and we'll use tech, and, but it's a reworking it, so what is lost can also come back and be gained. So it's not a zero-sum game, so it's going to, what it destroys in jobs, over time, new jobs will emerge, and hopefully they'll be more interesting for people.
Yeah.
I'm hoping that.
Well, just to kind of get things kind of wrapped up here, a couple more questions here. What are the drivers in energy investing? How would you invest now? Or maybe not just invest now. Let's look long term. Let's
Yeah.
not just look here in 2023. I mean, this is a long, I mean, we
Yeah.
have a long runway here.
Yeah. Well, it's really, with how the transition plays out, in terms of like, if I were picking a utility,
Mm-hmm.
I would focus on my region and what I know, and then look at those big players that are, really being successful per region. I kind of am liking the idea of majors, oil and gas majors that are, leaning into their core competencies in smart ways, using technology with their mind on the transition and how they can transition into, they're not just saying they're oil and gas companies, but that they're, integrated energy companies.
Mm-hmm.
So there's that kind of idea. And then I think there's just a lot of niche players in tech too, that are going to be doing things to look at. But right now, I kind of like some of the indexes, like the one I showed you, the semiconductor one, just because I am not going to spend a bunch of time focusing on tech stocks. I'm going to be aware, and I'm going to utilize indexes, to add into my energy portfolio, because that's what I know. So I stick to what I know, and then I add in, what is changing and what is transformative, and what is real and fundamental and can really move the needle on efficiency, and doing what is necessary, not just in a US energy context, but a global energy context. Because as we know, a lot of the energy demand is in other parts of the world. The growing demand is the developing world. And then you have the China factor, and there's been some slowdown a bit, with where we thought demand would be, and that's been reflected in, somewhat in the oil markets. But so that's kind of like just kind of something in the background that's just sort of a little bit of an uncertainty, about what's going on. I know they were drilling that massively deep, like 5-mile, hole in the earth in this region that's supposed to be an oil-rich region. And that's sort of interesting. Just the idea that they have learned what shale can do. I mean, they have partnered with some of the independents in the United States. They can apply those learnings, and I think you're going to see that too in oil and gas. Is just this, according to Exxon, that the developments in shale, the technology in shale is just early days, of what can happen. And so that's also very interesting. So I'm sort of staying the course, and then I've added in, some tech ETFs. That's kind of what I do with my tech, unless I am totally convinced about one firm. But for the most part, all my funds, all my ETFs have done great.
Yeah. Well,
Yeah.
yeah.
So,
Yeah. So any final thoughts here?
I would just say, with the energy transition and with tech, I mean, it's not like you can plan for 10 years, 20 years easily. You've got to readjust, every, I think you can go out 5 years,
Yeah.
and then, I mean, when you're planning, but then reevaluate more frequently. And I think that is what happened, that AI day, I think that reminded the market, the market was really excited by it, but B, it's a reminder of how fast something can come on, like the pandemic, and then, and shake things up. And we don't always know how it's going to shake things up. So I would just say, just you can't pause. That was one thing that the Atlanta Fed president said, we don't want investors to just pause and do nothing, so you do have to plan and place a bet, and that's, I'm doing that. I'm not stopping. So
There you have it. Yeah. It's really great to catch up, and it's very interesting, especially the bigger picture perspectives that you provide. It's a lot to think about. Definitely lots to think
yeah,
about in this one,
yeah,
and also all the other videos too.
yeah. I was happy to share what I learned with the Fed and just sort of playing it forward. Thanks again for having me. I enjoyed it.
Absolutely.